The Dow Jones Industrial Average finished today within a whisker of its all-time high. And on the exact same day, in the exact same market, the semiconductor index is sitting 22% below its own peak.
And let us be precise about that, because the precision is the story. The Dow ended about 0.2% under the intraday peak it set back on July 7th. So it is knocking on the door, not through it. But the divergence you are pointing to is entirely real. We have the industrials pressed right up against their ceiling and a deep correction in the chips happening simultaneously.
Right, and that is the central tension of the session today. When you look under the surface, something highly unusual is going on. You have to ask whether this is just a healthy broadening out of the market, or if the market is quietly giving up on the fast horses that got us here in the first place.
It is the only question that matters right now. And the data from today's session gives us evidence for both arguments, depending on which layer of the tape you want to believe. Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
Let us set the scale of what actually happened today, because this was a genuinely strong, broad session across the board. Nobody was hiding.
No, it was risk on everywhere. The Dow closed at 53,189.55, which is up 704.52 points, or 1.34%. The S&P 500 finished at 7,600.61, adding 110.89 points, a 1.48% gain. The Nasdaq Composite led the major averages, up 539.01 points, or 2.12%, closing at 25,912.86.
And volatility bled out completely. The VIX is sitting down at 15.86, so the fear has really drained out of the system, at least on the surface.
Exactly. And to round out the picture, the SOX, the semiconductor index, closed at 11,430.35. That is up 1.05% on the day. Positive, sure, but significantly lagging the broader market averages on a day, when buyers were throwing money at almost everything else. The easiest way to see the two realities of this market is to just walk down the ladder of how far different sectors are sitting below their own 52-week highs. The Dow is just 0.21% off its intraday high. The S&P is down 0.27%. Financials are down 0.38%. Industrials are off 1.76%.
So the traditional economy is right at the ceiling.
Right? Then you keep walking down. The Russell 2000 is off 2.12%. Real estate is down 2.74%. Healthcare down 3.73%. The Nasdaq is 4.69% off its high. Consumer discretionary is down 5.44%. Materials 5.78%. Staples 5.86%. Utilities 7.20%. And energy is down 7.36%. Then you fall off a cliff. Technology as a whole is down 10.41%. Software is down 17.43%. And semiconductors are down 22.01%.
But voice the objection here, because breadth broadening is supposed to be a good thing. Isn't this exactly what everyone asked for? For a year, the complaint was that the market was dangerously reliant on 5 tech names. Now the rest of the economy is pulling its weight.
That is the optimistic reading, the constructive breadth argument. The darker layer is that the index is only making a high because money is aggressively rotating out of the fastest growth engines and seeking safety and value. It is the difference between new capital entering the system to buy industrials versus capital fleeing semis and parking in the Dow just to stay invested. We do not have the answer yet, but that gap is the battleground.
To understand why equities pushed so hard today, you really have to look at the geopolitical wire. The catalyst was Trump calling off the planned airstrikes on Iran, and the suggestion that a framework for reopening the Strait of Hormuz is actually on the table.
That headline instantly drained the war premium out of the energy markets. Crude fell hard. Depending on the exact snapshot, WTI was down roughly 5% to about $80 a barrel, and Brent was down roughly 6.5% to 7% to about $84. Both contracts are now sitting below where they were before the entire Iran escalation even started.
And if you walk the chain of logic, that is the causal spine of the entire session. The geopolitical risk premium comes out of oil. Lower oil means the forward inflation path suddenly looks much cleaner. The bond market instantly prices that in, and the 10-year Treasury yield drops 1.24% on the day to land at 4.69%.
which creates the perfect environment for a mechanical equity re-rating. When the 10-year yield falls aggressively on an improving inflation outlook rather than an economic panic, equities almost always catch a violent bid. Oil paid for this rally today. What is fascinating is that the market entirely ignored a massive piece of conflicting macroeconomic data this morning. The ISM Manufacturing Index came in at 55.6. The expectation was 54.0, and the prior month was 53.3. That is a 4-year high for the manufacturing sector.
New orders, production, and employment all improved. And the employment metric is the critical one there, returning to expansion for the first time in 18 months.
Exactly. In a normal environment, a red-hot manufacturing print that includes expanding employment would trigger a massive bond market sell-off because strong data argues firmly against the Federal Reserve cutting rates. But today, the falling oil price mattered more to the bond market than the ISM data did.
But the tell that this isn't purely a serene, risk-free environment is sitting in the metals. Gold rose alongside the equity rally today. It closed at $4,115.80, up 1.65%, while the DXY dollar index sat at 99.96. The safe haven bid in gold has not fully unwound. The market is treating the Middle East news as a pause in the conflict, not a permanent peace. Let us go back to that 22% hole in the semiconductors, because the sector behavior today was deeply weird. The SOX rose 1.05%, but that means it underperformed the Dow, the S&P, and the Nasdaq on a day when traders were aggressively putting on risk.
That is the second straight session of semiconductors lagging into broad market strength. Remember, the SOX peaked above 14,000 back in July. Today, it is just treading water. And the internal divergences within the sector show zero real conviction. You had SanDisk up 6.03%, while Western Digital dropped 3.23%.
Two heavily adjacent names in the NAND flash memory space, trading 9 percentage points apart on the same day. And they both report earnings on Wednesday after the close.
Right, so that is pure position squaring ahead of the prints, not sector-wide confidence. If you look at the relative strength index, the RSI across the complex is still sitting in the mid-30s to low 40s. Micron is at 39.7, AMD is at 39.6, and SanDisk is at 35.8. That is the definition of a sector trying to build a base, not a sector resuming a bull trend.
The other massive story today happened overseas. Alibaba released Qwen 3.8 Max. We are talking about 2.4 trillion total parameters, running on a sparse mixture of experts architecture with about 95 billion parameters active per token.
It features a 1 million token context window. It accepts text, image, and video inputs, outputting text. And crucially, Alibaba is dropping the open weights for this on Hugging Face and ModelScope the week of August 10th, alongside a smaller Qwen 3.8 to 27B model. The benchmark testing places it at or near the frontier on reasoning, visual analysis, and several major coding suites.
But the detail that actually matters is the autonomous run they demonstrated. They let the model run for 16 days without any human intervention. It built a project called OhmyCii entirely from scratch. It filed and claimed its own GitHub issues.
The final numbers on that were staggering. 265 commits, 127 pull requests, and 151 issues handled completely autonomously. It also demonstrated a separate 5-day research paper reproduction. The market rewarded this today. Alibaba closed up 4.13% at $127.30, with an RSI of 70.2. The broader K-Web Chinese Internet ETF was up 0.88%. Though it is worth noting Alibaba is still 33.9% off its 52-week high.
Here's why this matters for the broader tech tape, regardless of what the exact license ends up being. When a 2.4 trillion parameter model gets open-weighted and anyone can download it, it compresses the price of frontier capability aggressively towards zero.
Which puts immense structural pressure on the per-token API economics that form the core revenue model for every closed-weight lab out there. If you are selling intelligence by the API call, an open-weight model of this scale is a direct threat to your margins.
Think of it this way. Imagine building an incredibly expensive, highly engineered toll road, relying on toll collections to pay back your massive capital expenditure. And then the city comes along and opens a pristine, perfectly paved, multi-lane free highway right next to it. You do not get to keep charging the old toll. You have to find something the free road cannot do and charge for that instead.
It forces a complete recalculation of how those closed-weight labs are going to monetize the billions they're spending on compute. That is the real gravity pulling on the software and semiconductor sectors right now. The capabilities are advancing, but the path to monetizing those capabilities is getting vastly more complicated when competitors start giving away the frontier for free.
We also got confirmation today on what exactly happened in the foreign exchange markets late last week. The US and Japan officially confirmed that they jointly intervened to buy yen. The operation itself actually took place on Friday, July 31st.
This is a massive shift in policy. It is the first joint US-Japan yen intervention since 1998. The coordinated operation deployed roughly $36.5 billion. For context, Japan had previously spent as much as $59 billion in a single day on solo interventions. The joint effort worked. US dollar to Japanese yen dropped from near 164 down to about 156 before settling around 157 today.
But the mechanics of how Japan plans to fund future interventions is the truly interesting part. They announced plans to utilize the Fed's FEMA repo facility. That allows them to pledge U.S. Treasuries as collateral for short-term dollar funding, meaning they can intervene in the currency markets without actually having to sell their Treasury holdings outright.
Which leads perfectly into the widely reported analyst interpretation of this whole event. The read is that Washington stepped in to help primarily to stop Japan from dumping U.S. Treasuries. If Japan sold heavily, it would push U.S. yields and domestic borrowing costs up at the exact wrong time. In other macro news, global PMIs are expanding. U.S. at 55.6, the Eurozone at 51.9. Japan, China, and Taiwan are easing but still above 50, while Korea and Southeast Asia are rising. And we heard from the UI Fed's Williams today, who expects inflation to keep slowing through the second half and into 2027, calling current policy appropriate but data-dependent. Looking at the week ahead, the calendar is incredibly heavy. AMD reports Tuesday after the close, with consensus expectations at $1.35. The stock is 17.1% off its high, with an RSI of 39.6. SpaceX also reports Tuesday, giving us their first quarter as a public company.
Then Wednesday is the memory test, with SanDisk and Western Digital reporting alongside HubSpot, which is our prime bellwether for per-seat software licensing. Thursday morning, we get Datadog pre-market, followed by Cloudflare and Atlassian after the bell. That completes the consumption versus per-seat health check.
But it all brings us back to the question we started with. Is this rotation into the Dow a sign of healthy breadth, or is it the market abandoning the fast horses? Here's how we would think about it, though you may see it differently. The real test is not what happens when bad news hits. The test is what happens to semis when good news hits.
Right. We need to see whether the market actually rewards a beat or whether it just uses the liquidity of an earnings event as an opportunity to get out. We do not have that answer tonight.
We do not, but we will very soon. The clearest tell will be how the market treats AMD on Tuesday night. If the print is clean and the stock gets sold anyway, that tells you capital is genuinely migrating away from the chips. If it beats and the sector catches a bid that actually holds through the week, then what we watched today was healthy digestion and nothing more sinister than that. Either way, we should know a great deal more by Friday.
That's a wrap. If this was useful, follow or subscribe for the next one and tell us where we're wrong. Thanks for listening.